Welcome everybody to Options Trading, brought to you by Alpha Traders. This video we're going to talk about order execution. Now, we did cover a lot of this in the last video. This will be a fairly short video, but we do want to cover it just one more time just to make sure it's really locked in there. As you can see, this is 7 of 9. We just talked about calls and puts. After this, we will take a look at some more advanced options. So now that we talked about options, what they are, what an option sheet looks like, let's talk about placing an actual order for a contract. So one thing to remember is that when you're buying a contract for 100 shares. The price that you see is only going to be for one share. For example, if we see an options on the sheet and it's going for 50 cents, this is going to cost you $50. All right, so once purchased, you do have control of 100 shares for a buy or a sell, but that's still considered one single contract. You can buy 10 contracts if you would like, all at 50 cents, and that's going to run you $500. But then at that point, you would be in control of 1,000 shares. So luckily, that's about the biggest difference between executing orders for options as opposed to stocks. Depending on your exchange, you should have the ability to set limit orders as well as market orders. You will need to check with the exchange to see if they have stop losses. Some of them do not. I know it seems a little strange, but with options, you don't always have the same flexibility you do in the traditional stock market or in Forex or in crypto or any other market for that matter. All right, so you do have to double check on as far as stop losses, trailing stops, take profits, those types of things. You will need to double check your broker and see how they handle it and see what kind of features that they have available to you. So using our example of AMD, let's see what buying a call option and buying a put option would look like. We'll take each position 3 brackets out. We spoke about brackets in the last video, and that means we're taking the third available out the money options contract. So here is the same table we looked at before. As we can see, the November 20th, 2020 strike, 91 days away at the time of this, the screenshot was prepared. And again, from 65 to 105, current price 83.18. That might be slightly different, but it's still in that same ballpark, 82.50 and up. And now we're going to take a look at what the calls and puts would look like 3 brackets out. All right, so you have 1, 2, 3 brackets down, 1, 2, 3 brackets up. So over here, if you were going to get yourself a put, 77.50, that put is from a 6.55 bid to a 6.70 ask. Again, it's about the same, 15 cents or $15. Multiply that by $100. That is going to cost you $670 at market, $6.55 if you get the limit filled. On the call side, $90 strike rate, 3 brackets out from your current in the money over here at 82.50. That comes down to, again, 690 is the ask. That would be your market, and your limit at 680. So this is only a 10-cent spread or a $10 spread, 680 to 690. Let's see it all written out with words. Buying one call option would look like this. AMD call option, strike at 90 with an expiration date of November 20th, 2020 for the price of $690. This will cost you $690. This option means that we expect the price of AMD to meet or exceed $90 with the current price of $83.18 by November 20th, 2020. If the share price of AMD is not $90 or higher on November 20th, then the options contract will expire worthless. That $690 you put in there would eventually be considered $0. It would be absolutely worthless if AMD did not meet or exceed your strike of $90. On the put side, buying one put option would look like this. AMD put option with a strike of $77.50 with an expiration the same, November 20, 2020, for the price of $6.70. This will cost you $670. This option means that we expect the price of AMD to meet or fall below $77.50 with the current price of $83.18 by November 20th, 2020. If the share price of AMD is not $77.50 or lower on November 20th, then the option will expire worthless. Again, this is assuming that you think the direction is going down. That will cost you $670. If you are wrong, it will expire worthless. So you can use your expirations and you can use what you're willing to spend on your strike or that particular bracket as part of your risk management means of trading options. If you're okay with something expiring worthless, then that would end up being part of your risk management. That would be what you're willing to risk as a whole. So if that's $670 or $690, call it $700, is only, let's say, 1% of your total capital, then you could be okay taking that trade. You're only risking 1% of your capital. And if it were to not come to fruition and it did expire worthless, then you would only be out that $700. All right, so that was order execution. I know we basically covered it in the bread and butter video, but just wanted to go over it one more time. Really hammer that through. Make sure everybody understands how options can be executed like that. And we'll be moving on into the next video in just a minute. We will see you there.